Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a wonderful discussion lined up today. We're privileged to have with us John Ciampaglia, CEO and Senior Managing Partner of Sprott Inc. John has 30 years of investment industry experience, and he's been at the helm of Sprott since 2017. He's responsible for overseeing Sprott's public market investment strategies and is also the portfolio manager for the company's physical commodity funds. John, welcome to Metals and Miners, and thank you so much for joining us today.
Yeah, thanks for having me on. It's quite an interesting day to record this, given all the things going on in the world, particularly impacting metals and miners.
You got that right. Well, let's jump into some of them. We'll start with the Atlanta Fed GDP Now model cut Q1 real GDP forecast from 2.5% to negative 2.5% due to weak trade, PMI, construction data. Surveys indicate that a majority of Americans plan to cut spending in 2025, particularly on discretionary items. Housing and auto industries, key drivers of employment, they're showing signs of distress. Additionally, consumer sentiment reveals a growing gap between the present conditions, which right now are fairly stable, and future expectations, which are projected to be weak. This is a pattern seen before past recessions. Prominent investors also, including Steve Cohen, who I'm sure you know who he is, have issued bearish warnings advising caution, hedging risk, and accumulating gold. The overall outlook suggests mounting economic uncertainty. What is your position on the economy?
Yeah, well, it seems as though a few months into the post-presidency start of the election, the Trump sugar high is worn off, and now we're back into reality, which is really not a reality that's really being overwhelmed with uncertainty. I think in financial markets, uncertainty is always worse than bad news. And right now we just have so many elements of uncertainty given the wrecking ball approach that the current administration is taking with respect to its longtime trade partners, allies, et cetera, et cetera. You can clearly see consumers and businesses stepping to the sideline, delaying whether it's purchases or capital investment decisions until they get some clarity. So for example, today when we're recording this, is the effective date that tariffs are being applied to Canada and Mexico. I'm not sure anybody has really been set up to collect tariffs and who to remit them to. Is everything, included? And so for highly integrated economies where, goods are traveling back and forth over the border multiple times until they end into a finished state, nobody really knows what the rules of the road are in terms of what is subject to tariffs. Is it point of origin? Is it point of entry? And so I do think that with all the confusion and changes being announced, people just don't know what to do. And, when there's lack of clarity, the easy thing to do is move on the sidelines. And unfortunately, I think that's going to start to trickle into the economic data. Obviously, federal government spending is going to be curtailed. That is going to have some impact on the overall GDP numbers. But I think business and investment and consumer discretionary spending are also going to be weighed down here, and it is going to trickle through. So again, it's amazing. We've gone from this exuberance around very pro-business environment, cutting red tape, deregulation that got financial players and financial markets very excited. Just a few months ago to now, it's, oh my gosh, what does the new landscape look like? What are the rules of the road to doing business? And unfortunately, I think that is eventually going to trickle through into behavior, consumer behavior, business behavior, and these tariffs. Let's not kid ourselves. They are a tax. They are inflationary. Don't believe for a minute that these are deflationary or won't impact inflation. If the U.S. needs to import these goods because they're relying on other countries, then they're going to have to basically absorb those higher fees, and it will trickle through into the inflation numbers.
So let's dive into that a smidge more here, John. So the U.S. imported $413 billion from Canada, $505 billion from Mexico, which is our largest trading partner, and $440 billion from China in 2024. China's recently upped the ante and added new tariffs on key agricultural products. Canadian tariffs on U.S. car steel and aluminum, they're going to set to take effect here in a couple of weeks. So everything's kind of ratcheting up here. Higher food prices are expected, right? Because these are short cycle items. This is going to hit the bottom 60 to 70% of Americans much harder. They're already struggling with lower savings due to elevated inflation for the last 48 months. So now their monthly budget is about to get strained a little bit more. What do you see as the ripple effects, and how quickly will those ripple effects move through the economy?
Yeah, I mean, I think you hit on the right point in terms of who are the tariffs going to be, who's going to be impacted the most from these tariffs. And, where I'm sitting right now in Toronto, Canada, we export excess electricity to the US in the Northeast. They've announced today a 25% export tax. So for those consumers and businesses in the Northeast that rely, which they have for many, many years, on Canadian cheap electricity, which comes from nuclear power, comes from hydroelectric from Quebec, they may be asked to pay more for electricity. Again, the utilities really have one of two choices. Do they absorb the cost increase, or do they pass it through to the ratepayers? And obviously, time will tell. But obviously, basic necessity, items you cannot really substitute or thrift, are going to be impacted. The other item, which is a huge part of the trade flow north to south, is heavy Canadian crude oil. And though that form of crude oil is absolutely in demand amongst U.S. refineries, they need that heavy crude oil to mix with light crude oil that comes from Texas and other places in the U.S. And without that heavy crude oil, you basically are going to have shortages of diesel and jet fuel and things like that. So thankfully, the tariff on that is only 10%, not the 25%. But again, who's going to bear the cost? How does it trickle through the supply chain to the end customer? Again, most of these tariffs have been positioned as non-inflationary. We don't see how they're not inflationary, because at the end of the day, somebody is footing the bill for an extra tax.
So more than likely, the bottom 60 to 70% of the consumers, they're going to be holding back on some spending as some of these other items, move to the forefront, and that's going to impact certain industries. Who knows which ones? I guess we'll see as time goes on. I want to switch over to the Mag 7. Most of them are struggling. They look like they've topped. The Buffett indicator is 2.1 standard deviations from its historical mean. Billionaire investors, like we mentioned earlier, Steve Cohen, they believe a bear market will soon be upon us. Warren Buffett himself is sitting on a record pile of cash of something like $335 billion last count. It could be more. I don't know. How concerned are you for the markets?
Yeah, well, I think we're in an unprecedented situation in terms of resetting the game board, so to speak, in terms of geopolitical the relationships and the U.S.'s role in essentially the world order that's been placed since 1945. These trading systems are very well balanced. They've been conditioned over decades. They're fine-tuned. Supply chains, as we know, are very just in time, as we learned during COVID, and it doesn't take much to disrupt them. And tariffs is obviously a disruptive activity, counter tariffs. And so it's going to take some time to figure out, are these tariffs going to be prolonged? Are they really a negotiating lever that's being pulled to renegotiate the free trade agreement that has obviously been in place in North America since 1989? Nobody really knows what the end game here is, but in the short term, it's creating a lot of uncertainty. It's really weighing on investor sentiment. And, the investors that we talk to, the course of action is basically step away from the markets, de-risk, take some money off the table. The markets were really priced for perfection just a few months ago, if you think about it. Everything was riding high. There was a lot of excitement about AI and the CapEx cycle it was unleashing. And now you have to think, how are shortages of materials going to, translate into economic growth and supply chains and business decisions. So it's really unprecedented in terms of what's going on. We've just not had this kind of a shock to the system, I would say, since COVID.
Yeah.
As crazy as it sounds. And it's impacting metal markets specifically. There's obviously a movement afoot to bring metals from all around the world into U.S. storage facility and vaults, whether
Mm-hmm.
it's copper or uranium or gold or silver, steel, aluminum. The U.S. is still very dependent on other countries for a lot of these key inputs into manufacturing,
Mm-hmm.
monetary metals, and whatnot. So it's really unprecedented, and I think that's why people are concerned that with this kind of environment, like we saw in COVID, it can really spook market participants and cause a short-term correction, which we hope, if it does happen, will be short-lived and we'll get back to trading and operating as friends again.
So, speaking of operating as friends and whatnot, in the previous world order, we've watched, U.S. treasuries being sold to foreign nations, no problem. But, John, today, U.S. treasuries are in shambles. The biggest foreign nation buyers, such as China and Japan, they're major net sellers. And it seems like the majority of treasury buyers these days actually favor gold instead of treasuries. As the huge amount of almost $10 trillion debt wall approaches and annual deficits, those are still increasing. Do the powers that be maybe need to crash stocks in order to drive money out of those risk assets and into safe havens, thereby maybe saving treasuries?
Yeah, I mean, you raise a lot of interesting points, and obviously the aggregate debt load is getting to a tipping point where it could crush, the deficit, because for the first time in, I don't know, a very long time, the interest payments on U.S. debt is actually exceeds the defense budget, which is kind of an ominous sign that usually foretells the peaks of empires. Happened to the British Empire many, many decades ago. And so I think there is a concern about the absolute debt load, but the second part of the debt load is the term of the debt load. Participants, sovereigns, institutions, over the last few years have been very reticent to buy long-dated treasuries. Obviously, when they were yielding nothing, nobody wanted to lock in those yields to maturity. And so the Treasury has a big issue here around refinancing a lot of short-dated paper. And as you said, the typical historical buyers, where we would buy lots of goods from places like China and Japan, and they would recycle the dollars they received and put them in treasuries. That is kind of behind us. China has systematically reduced their amount of treasuries. They are not just allowing them to mature. They're actively selling them or pledging them as collateral for other initiatives to basically de-risk the pile of treasuries they're sitting on. And what you see on the flip side is a lot of those dollars coming out of matured treasuries or sold treasuries is absolutely being recycled into physical gold.
Mm-hmm.
The other factor that's happening in the last few years is, the seizure of hundreds of billions of dollars of financial assets that Russia held in the global banking system after the invasion of Ukraine was a real wake-up call for some countries that, oh my gosh, like we could be frozen out of the SWIFT payment system, and hundreds of billions of dollars of our assets and FX reserves could all be frozen on us, which is what's happened.
Mm-hmm.
And that is another factor that I think has driven some central banks in some countries to do a few things. One is repatriate gold stored outside of their own countries back home. We've seen that. And then the other thing is we've seen a lot of central banks accelerating their purchases of gold. And we think this is a concerted effort by a number of them, not just China. They've been the biggest, but it's a number of central banks to basically reweight the weight of gold in their foreign exchange reserves. Turkey's doing it, Singapore, Poland, India, obviously China. They've all been big net buyers of gold in the last year or so. Previous decades, they've been big net sellers of gold. And so that buying tension from a group of buyers who we view as price insensitive, when they have a policy goal to say, we want our FX reserves to be 25% gold, they're just going to keep buying gold until they hit that magical number. So it's one of the reasons why we've seen a lot of resiliency in the price of gold in the last 16 months. And then more recently, with all these looming, political and geopolitical risks that investors are starting to think about, we're starting to see Western investors thinking differently about gold. And the way we like to think about gold is it acts almost like an insurance policy, quasi-insurance policy. And so if you think a risk of something bad happening, an adverse event occurring, then you're willing to pay a higher premium, so to speak, for that insurance policy. That's the way we like to think of gold. The other role of gold is obviously a source of liquidity in turbulent times. So you are willing to pay a premium for that source of liquidity. And we've seen that obviously in the financial crisis of 08, 09. We saw that in COVID, where investors basically, I like to think of cashing in their insurance policy, being able to tap that liquid source of cash when other things are being disrupted. So we see the last few months a shift amongst Western investors back to physical gold. And we haven't seen this, I would say, since Q2 and Q3 of 2020, which we all remember what was going on in the world. And so people are reassessing risks differently for the first time in a few years. And that's definitely putting added buying pressure on gold in addition to the central bank buying I just mentioned.
Today's video is sponsored by Monetary Metals. What if your gold could grow over time so that you're not just preserving, but growing your wealth in an asset that can't get inflated away by more money printing? Monetary Metals lets you do just that. You could earn 3% on gold, paid in gold, in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even high as 19%, all in ounces of physical gold and silver. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. The question is this: why earn in dollars when you could earn in gold? Join thousands of investors earning interest in physical gold and silver every single month with Monetary Metals. So visit monetary-metals.com/BOOM to learn more. So there was a lot there. And that was a great perspective. I appreciate that. The metals and mining industry is seeing a surging demand for critical minerals. The U.S. government and other governments have restated their critical minerals needs. They've put together some protectionist policies. The U.S. is trying to negotiate a deal with Ukraine to secure critical minerals as payment for their huge assistance in the war. Countries, not just the U.S., they're becoming more and more protectionist over their supply. And yet over the last 10 plus years, there's been a shortfall of investment into this asset space as investors have chosen crypto, real estate, tech stocks, etc. So critical minerals, they're needed for humanity's continued progress. I mean, let's just be clear here. What do you see coming as demand and protectionist policies continue to ratchet up and sustaining capital investment continues to lag behind?
Yeah, it's a really good point. I mean, prior to all of this trade and tariff rhetoric, we already saw structural supply deficits in place for a number of critical minerals and looming supply deficits for others. And so part of the thesis around tariffs is you're basically incentivizing more production in your own country. I'll use some examples here that I think they're really tangible. The most compelling, I think, illustration of this is uranium. And so today, the U.S. operates the largest fleet of nuclear reactors. Those reactors produce 19% of electricity for the country. They require almost 50 million pounds of U3O8 uranium every year to operate, as the feedstock. Now, how does that contrast to the production of uranium in the United States? Well, 2 years ago, it was zero. Last year, it was about 325,000 pounds. And this year, maybe we'll get to, 7, 8, 900,000 pounds, maybe 1 million pounds. And so there's an example of a mineral that is critical that the U.S. is largely dependent on other countries for, including Canada. So Canada right now ships or I should say, supplies about 30% of U.S. uranium needs, which is now officially, I guess, subject to a 10% tariff, which isn't as bad as a 25. And obviously that is going to act as some incentive to give local producers an added,
a push
value, right, in terms of a financial incentive to produce more uranium. But then the question becomes, what is their ability to produce more uranium? The answer is not a whole lot. For the reasons you just outlined, we haven't invested in the sector for 10 plus years when prices were suboptimal. Nobody had any economic incentive to do these projects. Secondarily, uranium mining has largely been depleted in the United States. The United States has not produced huge amounts of uranium since 1980. So, it's not like you can just turn on a lot of these old mines and
Right.
really stimulate a lot of production. Well, let's go back into more recent past. Let's go back to, let's say, 2011. The U.S. that year produced 4 million pounds of uranium against, as I mentioned, annual needs of 50. So, you know, there's no real solution in the near term, and in terms of being self-sufficient. And I can go on. Copper is another key one. Nickel, heavy Canadian crude oil, obviously, is a key input for U.S. refineries. So the world right now is trying to recalibrate itself, trying to figure out. I've heard. I saw one Canadian miner today saying we're just going to ship all our metal to Asia. We're not gonna ship it to the U.S. So the question then becomes, what happens if shipments of copper, uranium, nickel, and other critical minerals that are used for energy, defense, manufacturing, what if they pivot to other markets? How does that play out? How does that disrupt supply chains and whatnot? It's hard to believe we're talking about this, but this is the situation people are trying to assess right now. And look, maybe cooler heads prevail, and this is all a big grand renegotiation tactic, and we get back to business. But in the short term, this is obviously creating a lot of what-if scenarios for investors.
Yeah, you said that right. So you mentioned earlier, really the main key reasons as to why the central banks around the world are diversifying their reserves away from treasuries and towards gold. And with the 25% number, I think I saw in Europe, they wanted each of the European nations to hit 4%. And none of them are there yet. So everybody's looking to acquire gold, except you don't hear the U.S. talking about acquiring gold. So is there a catalyst that will lead the U.S. to acquire more gold than the 8,133 that they own? And if so, what do you see that as being?
Well, first of all, let's distinguish what they own and what they claim to own, because nobody really knows what they own. The
Right.
gold there hasn't been audited in a very long time, and obviously, President Trump and Elon Musk have talked about going to Fort Knox to audit the gold. The more important question to ask is not whether the bars are all there, but who owns the bars. How
Right.
many of the bars have been loaned out, leased out, whatever, pledged against other, financial transactions, et cetera, et cetera. So that's the more important question. But you're right, the U.S. is, from a central bank perspective, not been accumulating gold because the U.S. has had the luxury of being the reserve currency for the world for decades. They don't need gold. When you have a weak currency, that's when you need to offset your FX reserves with something very tangible and obviously a store of value that's been in place for thousands of years. So it's a very different perspective if you're, the central bank of Turkey versus the, central bank in the United States or Canada or another Western country. But I think there's something afoot going on in gold, and it feels to us that the current administration wants to remonetize gold, wants it to play a more important role going forward, wants to perhaps revalue the gold it has on its books, which is still sitting at 40 something dollars per ounce. And it's impossible to know. This is all kind of speculation, but it sure feels to us like something is going on with gold, and it seems as though it's going to like I said, I like this term, reassert its role as a monetary metal,
Yeah.
which it hasn't really played in a lot of Western for a lot of Western countries for some time.
So it does feel like something's afoot, but I mean, Treasury Secretary Bissent came out and he shot that revaluation theory. That horse is not out of the barn. It's dead in the barn,
He also said
according to
tariffs
him,
aren't.
anyway.
Yeah, he also said tariffs aren't inflationary.
Right.
So I think we have to take everything with a grain of salt right now, just given how quickly things are moving.
Yeah.
But something seems to be in the works. And again, it's impossible to speculate how it all plays out, but it seems like there is something bigger afoot to basically address the elephant in the room, which is the debt load is so enormous, and the buyers have moved away, and they need to somehow solve it.
Yeah, I totally agree with you. And to your point about his raising that, tariffs are not inflationary. Today, Target came out and said that they're going to be raising prices to offset the increased cost in tariffs. So that's inflationary right there. All right. So moving over to silver, it's a hybrid metal. It has a ton of industrial uses. And with AI, the electrification of everything, et cetera, it's really in very high demand. Historically, it's been a monetary metal. With that history dating back thousands of years. However, central banks, they don't really accumulate it, although I think it was September, October timeframe that Russia came out and said that they would maybe begin accumulating it as part of their reserves. What are your thoughts on silver's value as a monetary metal moving forward, especially as the price of gold continues to climb and retail investors look at both as investment and savings vehicles? Some folks might look at gold and say, silver's looking more attractive here.
Yeah, you raise a lot of interesting points. I mean, we're obviously very bullish on the price of silver. It is at a very depressed level relative to gold. I quite frankly am astonished. The price of silver is still way below its all-time high. That's more than a decade ago. So that's that gold silver ratio, which we look at from time to time, is kind of flashing, very low valuation relative to gold. Now, there's obviously very different drivers behind the two markets for the reasons you outlined. Central banks don't accumulate silver, so you don't have that buying tension from that group. But where you do see buying tension on silver is the enormous and growing amount that's consumed and not recovered in things like photovoltaic panels. So about 20% of silver production right now is going into solar panels, most of which China is manufacturing and selling to the world very, very cheaply. So we don't see that trend slowing down. There are other industrial uses as well, given how conductive silver is. But right now, I think silver is being weighed down by its industrial elements like copper and uranium and nickel and whatnot are. But what we have always seen is that when gold goes, perhaps silver gets dragged along begrudgingly in the beginning, and then silver typically catches a bit of a bid and it kind of slingshots by gold. Feels like we're setting up for that again. What you also are starting to see is that substitution that you mentioned. It happens mainly in retail with retail investors, not institutional investors, but you're seeing that in markets like India, where the price of gold is becoming prohibitively expensive for people there who always buy precious metals as a store of wealth. And you're seeing huge imports of silver going into places like India as they substitute for gold. So we see that trend continuing. It's going to be interesting to see what happens with silver, because if there's a lot of retail investors in the United States that buy silver, think about where that silver comes from. A lot of it comes from Mexico. Is that all going to be subject to a 25% tariff, which is obviously going to translate into higher prices for coins and bars? Well, it could. And so that dynamic is going to play out. But silver, we think it remains very cheap relative to gold. It doesn't have that same institutional and central bank kind of support behind it. But if retail investors start to buy, silver tends to kind of spring by gold, and that's something we're watching for.
Yeah, I think I am as well. So, John, moving over to the miners, why do you believe retail participation in gold mining stocks has remained relatively low despite gold reaching nominal all-time highs? I mean, investors, they've typically viewed gold stocks as a leverage play on the price of gold. So what factors do you believe are contributing to the lack of retail buying in the mining sector, and do you expect that to reverse?
Yeah, I would first off say that that situation is playing out not just in retail investors, but also institutional investors. The last few years, there's been a real disconnect between the price of the commodity and the performance of the miners. I thought last year was a really good point to highlight, where you've had two of the world's largest miners really struggle and underperform the price of gold, which really begs the question, well, why would I want to take these incremental risks related to gold mining stocks if the price of metal more often than not outperforms it? And so that's the real challenge for these miners, is getting control of their costs, because that was a big problem. Some of them were obviously dealing with some geopolitical, resource nationalism issues. But in the last few months, for the institutions we've been talking to, I've definitely noticed a change in sentiment and an improvement in interest in the gold stocks as well as physical gold. And we've always said to people, it's not one or the other. You need to have gold as kind of your foundation. I always think of it as a pyramid. Gold should be kind of on the bottom. It's the foundation. It's the asset class that provides very different diversification and correlation attributes to your overall portfolio. And then the gold stocks, you're trying to obviously capture optionality and operating leverage. And you know, as I said, in an environment the last few years where cost inflation in mining has been really excessive, they haven't captured a lot of that operating leverage, which is why some of the stocks have underperformed. It seems as though the cost structure issues are starting to come, under control. The bottom line results, the cash flows are looking really, really good now, and we see renewed interest in the space. So I think things are looking more favorable. Even with the rally we've seen in gold stocks, when you look at the valuations of them relative to physical gold, they still remain quite cheap on a relative historical basis. So that to us says that it's not a crowded trade. People are just starting to sniff around a little bit. And, you made an interesting comment about there's a lot of competing investments or asset classes for gold stocks. I think crypto is probably the one that sucked a lot of oxygen out of the room. If you think about the role that gold stocks have played historically, they always were, more of a speculative investment for investors. And with the proliferation of cryptos and the proliferation of structured ETFs and, levered ETFs and all these kinds of things, investors just seem to have countless ways to impale themselves on these, structured products and financial engineered products. You can tell I'm not a big fan of them. And unfortunately, they've siphoned a lot of money away from traditional risk assets.
Maybe on purpose.
But anyways, nonetheless, there's definitely been a proliferation of these very, volatile, instruments that people can play with. So it's, but as I mentioned, when we see institutions asking different questions about gold and gold miners, that to us is a very interesting sign because they're taking a longer term view. They're taking a more pragmatic approach to the asset class. And we've had a lot of very interesting discussions with institutional investors about gold and gold stocks over the last few months.
Wonderful. So when looking out across the spectrum of gold and silver, miners, where do you see the most value today in terms of the segment? Is it across exploration, development, production, royalty streaming? Where do you see the greatest value?
Yeah, well, our team at Sprott right now, I would say, is more focused on the mid cap part of the sector. Last year, Barrick and Newmont really struggled. Performance-wise, things seem to be getting a bit better. Mm-hmm. And we've been more positioned in the mid-cap names, companies that are, the smaller producers, but again, not the tiny small caps. For most of our portfolios, we've been kind of in the next tier of production. We think that's where you get better risk reward in terms of growing reserves and production. The big companies are great, but the challenge is just growing reserves. They're just constantly depleting. And so we like to focus on companies that are in earlier stages of development. It is a tricky space, so you have to diversify. There's always surprises amongst these gold stocks. So, we tend to take a pretty well-diversified approach with, the number of holdings. And it takes a lot of work. We have a lot of geotechnical experts, geologists, and mining engineers that we lean on to really do the technical due diligence on these companies to make sure that their mine plans are solid and their deposits are solid. Mining is a very, very challenging business, so we do a lot of on the ground digging, pun intended, to make sure we're optimizing that risk reward.
This has been a fantastic conversation so far. Hey, everyone, welcome to this interview with John Ciampaglia, CEO of Sprott Inc. It's been an amazing discussion. And before we wrap up here and we have our final set of questions for John, I want to direct everyone interested in the metals and mining sector and investments to dive into our Substack at metalsandminers.substack.com. Join our community, receive a free report titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content, All premium content provides a comprehensive analysis for more informed decision making. Even without premium, there's plenty of free content daily, so visit metalsandminers.substack.com to join us and explore. Thanks again for watching this interview. Now, I'm positive that you've enjoyed the conversation with John as much as I have. Please let him know, hit the like and subscribe button, and leave a comment below the video. John, we're going to finish off our discussion with what I call a lightning round. I'm going to ask you to rank a few assets as a buy or a sell by giving them a score of 1 to 100, with 100 being an extreme buy, 1 being an extreme sell. And then just give me 1 or 2 sentences as to why you're taking that position. If you're not following the asset, that's okay. All right, so right now, on a scale of 1 to 100, is gold a buy or a sell, and why?
Yeah, we always view gold as a buy, and the reason is it's not price driven. It's the attributes we want it to play in a portfolio. We view it as the ballast in the portfolio, and we always advise our clients to have some portion of gold. That doesn't mean, you back up the truck and you're 100% gold, but it helps you stay diversified, helps you invest in more volatile asset classes. So it's hard for me to give it an exact number, but given what's going on in the world right now, we're very constructive on gold.
Okay, sounds like you're saying 100 because you're always wanting it in the portfolio. On a scale of 1 to 100, are gold miners a buy or a sell, and why?
Yeah, I think the environment for gold, given the current price of over $2,800, is very supportive of gold stocks, given their relative valuation. Again, you need to take a diversified approach because some of these companies can hit hiccups with production or geopolitics or whatever, wherever they're operating. So take a balanced approach. ETFs are very popular. We're much more constructive on gold and gold miners, I would say, in the last 12 to 16 months than we have been in a while. So I'm going to say about an 80.
Okay. Silver, 1 to 100, and why?
Yeah, silver, I would say, is your value trade. It is very cheap relative to gold. It has not kind of caught a bid. It's been trading in a very choppy sideways pattern for about 4 years now. We feel like it is ripe to break out. It's hard to see what the catalyst will be, but I think retail buying around the world is one of the things that will help put a good bid in for gold and help support the price. I'm going to say maybe a 90.
Silver miners.
Yeah, silver miners. That's a very hard, actually, asset class to invest in because most silver miners are not silver miners. In reality, they're gold miners with some silver. A lot of silver comes from byproduct of different forms of mining. And so it's very hard to get pure play silver exposure. There are very few companies left. At Sprott, we recently developed an index with our partners at Nasdaq to develop what we think is the most pure play silver miners ETF out there that trades in the US. The ticker is SLVR. Have a look at it. It has about 70% physical and mining exposure to silver. We're very constructive on silver. We just launched that fund the last few months, so I think that's a good indication of our thoughts on silver miners right now.
So what number would you give it?
I would give that maybe a 75.
Okay. Copper, 1 to 100.
Yeah, copper is another metal we're very constructive on. It's obviously a very big liquid market, but it has the risk of really getting turned upside down in this tariff war, given how important it is for so many industrial applications. The market right now on a physical basis is balanced, but is projected to be in a supply deficit position. And if the price of copper weakens, you're going to see a lot of projects put on ice because it's just not supportive. So while copper short term is kind of being really caught up in the trade war and the tariffs, medium, longer term, we're quite constructive on copper. I would give that right now maybe a 60, just given the overhang of tariffs.
Okay. Uranium, the metal. Then we'll do the miners after. So 1 to 100 on the metal itself.
Yeah, I would say the metal right now, we would be probably at 100. We feel as though it's very depressed right now. It's had a severe correction in the last few months, which we do not think will stay prolonged. And the reason is simple. It has probably, of all the metals, the biggest structural supply deficit. We need a lot more uranium production, and with low prices, it is not going to act as an incentive to get new mines built, which have to happen in the next 5 to 7 years. So Short term, this price correction has put us in very maximum bullish position. That doesn't mean we can't see a further sell down, but we think we're closer to the bottom, and the trade is starting to feel very asymmetric to us like it did 3 years ago.
Okay. And the miners, uranium miners.
Yeah, uranium miners, same thing. They've really sold off in the last few months on the back of softer spot prices and obviously getting caught up in this trade war. On a relative basis to the miners, they're about as cheap as they've been in many, many years. Very oversold. And so if you have the stomach for volatility, we think there's a very interesting trade here. If you've got a medium-term time horizon, I'm going to say 90.
Okay. Oil.
Oil. Contrary to drill, baby, drill, we think the oil price is kind of stuck here for some time. We don't think oil companies have much incentive at all to really expand production. They need much higher prices to make those CapEx investments. So drill, baby, drill sounds great, but in essence, I don't think the industry is gonna fall for it, and prices are largely going to stay in a tight band. So I'm going to say kind of 50 or neutral.
Okay. Nasdaq.
Well, Nasdaq was kind of priced for perfection a few months ago. It's obviously some errors come out of the balloon. Tech stocks are obviously the key driver there, and there's a lot of uncertainty around this AI cycle. How much CapEx is going to actually be spent? How much return on investment they're going to be? There's still lingering uncertainty around this Chinese DeepSeek AI model and whether it's real and how that's going to play out. So I still think those are great companies. They have almost monopoly-like businesses.
Yeah.
And so they are always going to trade at very high valuations. But in the short term, there are some downside risks, particularly if people get jittery about equity markets because they're so top-heavy in all the bellwether indexes. If people start pulling money out of equity markets, they just will disproportionately feel the downside like they do on the upside. So I'm going to be more neutral there at around 60.
Okay. And to your point on the DeepSeek, I think it was after that news broke, after they dropped their latest AI program, is when Microsoft pulled out of a few data center contracts that they've had.
Yeah, I mean, there was a lot of chatter about that a week ago or so, and Microsoft responded pretty strongly and said, "Hey, our capex budget of 80 billion in 2025 is not changing. Yes, they fine-tune a little bit. I think people need to take a step back and say their electricity portfolio driving their AI data centers is 19 gigawatts. Moving a few hundred gigawatts here and there is to me not a strong signal."
Yeah, I appreciate that. All right, S&P 500, 1 to 100.
Yeah, I mean, it's obviously less tech skewed, more diversified. So it probably has somewhat lower downside risks if we have a correction. There are some defensive sectors in there like, consumer staples and energy, which probably do a little bit better because they're not trading at crazy valuations. So, maybe in the 60 handle as well. It really depends on investor sentiment and the economy here, what happens, whether this risk-off appetite permeates and spooks investors.
Just a couple more. We're going to go short-term treasuries and then long-term.
Oh, interesting. I am not a fixed income expert. I don't spend much of my time there, so I don't want to hazard a guess. But on the short-term side, which is really Federal Reserve driven, the Fed seems stuck here. They're not really sure how these tariffs are going to play through into the inflation numbers, the job market, consumer spending. This is not something they have they can model, numerous examples from, I don't know, maybe back in 1930, they can look at scenarios. So it's not something they can easily model. And I think in the absence of clarity, it's stand pat. So I think short-term rates largely stay flat. Longer-term rates have obviously come in significantly and for the wrong reasons. Growth expectations are falling, uncertainty, and there's been obviously a little bit of flight to safety to treasuries, irrespective of longer-term views, which is inflation is likely to be higher, and so longer-term treasuries, longer-term, don't look like a great investment to us.
Okay, so that was going to be my question. I know you're a metals guy, but I mean, are you willing to even dip your toe and diversify into short or long-term treasuries, or are you staying out of that asset?
Yeah, I mean, treasuries obviously have a role to play in a financial calamity. They will absolutely rally in price, irrespective of the long-term prospects. So it's really, I guess, event-driven in terms of how that plays out.
Okay, and finally, on a scale of 1 to 10, with each representing a percentage, like 1%, 2%, where do you see inflation ending this year, 2025?
That's a great question.
And it could be a range, 3 to 4, 4 to 5, higher, whatever.
Yeah, I think our house view is that the days of 2% inflation are gone. That was kind of a Goldilocks scenario that central banks got to benefit from for a long time. We see inflationary pressures in the 3 to 4% is kind of the new norm. And I think that's one of the reasons why the Fed is kind of frozen here in terms of not cutting rates anymore. So 3 to 4% depends on, how supply chains are disrupted and obviously lots of other decisions that people make. But we think the new norm is 3 to 4% is probably a target for U.S. inflation, unless we have some kind of major economic meltdown and we have some disinflationary pressures.
Fair enough. Yeah. John, thank you for coming on to Metals and Miners. You've really been so generous with your time, analysis, and ideas. Would you please share with everyone where they could learn more about your work, how they could find you and connect with you?
Yeah, we really encourage investors to come to our website, sprott.com. That's SPROTT.com. Go to our education tab. There's a fabulous podcast and insight section. We write reports every month about precious metals, uranium, critical minerals. We've got great in-house subject matter experts, as well as third-party guests that come on our podcast. Please educate yourself, understand what you're investing in before you make decisions. And, it all starts with education, which is why we do so many of these events.
Yeah. Well, I will have that information up on the screen for everybody to click through, get over to your site, check out the podcast, the educational material, and, maybe ping you a time or two as well. John, I really appreciate you coming on here, and I look forward to having you back on sometime soon. And everybody else, thanks for watching.
Thanks for having me. Appreciate it.
Hey, everyone. Welcome to this interview with John Ciampaglia, CEO of Sprott Inc. It's been an amazing discussion. And before we wrap up here and we have our final set of questions for John, I want to direct everyone interested in the metals and mining sector and investments to dive into our Substack at metalsandminers.substack.com. Join our community, receive a free report titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content. All premium content provides a comprehensive analysis for more informed decision-making. Even without premium, there's plenty of free content daily, so visit metalsandminers.substack.com to join us and explore. Thanks again for watching this interview. Now,